This is a department or division within the organization for which revenues as well as costs are established. Its performance can be calculated using profits. This particular center is majorly in charge of just calculating profits. That is just what they are into. Sometimes it might just be okay, gathering every single information from all departments. They'll be the ones to like get information from the revenue, get information from the cost department, and be the one to calculate, oh, are we making profits or not? So obviously their own performance will be to calculate the profits that has been calculated by them, that okay, are they making profits? How is their performance? Is there increase in profits or not? Moving on, we have something called the revenue center, a department within the organization for which revenues are established. There are some departments, there are some organizations that have separate department that is just in charge of revenue collection. In an example can be in an organization where they have where we have where they are manufacturing goods. There is possibility of them having something called sales department. Sales is the same thing as revenue. There's something called sales department. Theirs is just in charge of calculating the amount of sales they are making. They are the ones in charge of getting goods out there to the customers and also recording them and calculating the number of sales they've made within that particular period of time. So the next thing we have is the cost center, a department for which costs are established in order to measure the cost of output produced by the center. Its performance can be calculated by comparing actual costs with budgeted costs. So cost center is basically the opposite of revenue centers, where revenue centers are the ones calculating the volume of sales made in that particular period. The cost center is the one calculating the amount of costs incurred in production. So they might just be in charge of calculating the costs incurred during the production process. So this can be measured, their performance can be measured by comparing the actual cost incurred with the budgeted costs, which we've dealt with under variance classes and other prior classes too. So moving on, we have something called decentralization of authority. This involves the delegation of authority within an organization. A divisionalized structure refers to the organization of an entity in which each operating unit has its own management team, which reports to the head office. When we say decentralization is talking about when we break down something into groups or departments. Everybody is now coming together to achieve a particular goal, but it has been divided. It's not as if everybody is performing the same role. Everybody has their own role. But it is because of decentralization that all these different centers are possible. Because of decentralization, we have the people that are managing revenue, we have the people that are managing cost, we have the ones managing investment, we have the ones managing marketing. So this decentralization allows for everybody to have their own roles, have their own role in the organization. Then everybody will now come together to report to the head office. It says the structure refers to the organization of an entity in which each operating unit has its own management team, like I explained earlier, which reports to a head office. Divisions are commonly set up to be responsible for specific geographical areas or product line within a large organization. If it's a small organization, they might just have separate departments in respect to sales, production, investment centers. But when it comes to very large organization, they might even have it might be so decentralized in a way that each product line will have its own centers, its own department. Example can be probably, let me use 7-Up as example. They are producing 7-Up drink, they are producing Pepsi drink, they are producing other types of drink too. So they might have the sales department for 7-Up, the production department for 7-Up itself, investment center for 7-Up. Then they might have the same thing for Pepsi too. Cost center, revenue center, investment center. So that is what we mean when we talk about decentralization of authority. So moving on, profit is a key measure of the financial performance of a division. Remember, the topic we are dealing with today is divisional performance. That is, how are we able to measure how a particular department is performing? How do we know how a manager is performing? How are we able to check if a particular department is performing well? So we say profit is a key measure of the financial performance of a division. It is divided into two: costs that are controllable by the manager of the division, and also costs that are traceable to the division. These are controllable costs plus other costs directly attributable to the division. Let me explain what I'm saying. In order for us to know if a company is performing well, we make use of profit. Fine, profit is not the best term, but it also assists us in arriving at whatever it is we want to achieve. Remember, the major goal of every organization is to increase the wealth of the shareholders, right? But despite the fact that profit is not the major goal, it is also one of the most important criteria to be able to tell if a company is doing well. So in using profit, we have divided profit into two types. We've divided it into the ones that are controllable by the manager. Perhaps we've divided it into two: costs that are controllable by the manager or the division, and also costs that are traceable to the division. That is, this type of cost is the one that is controlled by the manager, the one that the manager has opinions on it, that should we incur this or should we not incur it. We can refer to these ones as something called probably direct costs. Direct costs, because the manager has influence on this particular direct cost. We can say a direct cost to a sales department can be probably cost incurred in the gathering of data, or cost incurred in the transportation of goods out to the customer, or whatever it is they consider direct in their own to their own department. And indirect cost to them can be a form of rent, despite the fact that every single department has separate responsibility. They can't escape the fact that everybody is sharing the same rent amount. So that type of cost is not controlled by the manager. So moving on, I explained earlier that in order for us to be able to calculate how well a particular department is doing, we use something called return on investment, or accounting rate of return, ARR. So now we're going to calculate how we're going to see how to calculate return on investment. So return on investment is a measure of divisional performance for investment centers, like I explained earlier. And how do we calculate it? If we want to check if how well a manager is doing, because there's sometimes that what we want to do is check if a manager is doing well, or if a particular division is doing well. If a manager is doing well, we're only going to be using something called controllable profit. Controllable profit is the profit derived from operations controlled by the manager. And I explained the other time that most of it refers to when we are talking about costs that are directly attributable to that department, cost that is controlled or as that the manager has influence on. So the profit derived from this is known as the controllable profit, and we make use of it in evaluating how well a manager is performing by saying controllable profit divided by the capital employed multiplied by 100%. But if we want to check how a division is performing, that is, the whole department is performing, in this way, we've allocated a particular percentage of uncontrollable profits to it. The profits that is not controllable by the manager, we've added it to the controllable profit. That is controllable profit plus uncontrollable profit, or controllable profit plus other costs directly attributable to the division, or other profit directly attributable to the division where the manager does not have control. That is what forms our traceable profits. Then we divide it by our capital employed multiplied by 100%. We are going to solve it. What's it called? We are going to solve it as the class proceeds. But let me just explain every single thing in that formula. I said controllable profit divided by capital employed, and how to now get profits. I said profit is usually measured as an accounting profit after deduction of any depreciation charges on non-current assets. Remember the formula I stated earlier: profit divided by capital employed. If you want to remove the term controllable on traceable profits, note in your exam, if the profit has not been divided into controllable and traceable, don't bother yourself about doing that. Just take the profit as it is. It is in your pack that they've separated it, that we have controllable profit, we have traceable profits, and it's good for you to know it. In your exam, there is a very slim chance they will actually separate it like that. But in case they do, you should know how it applies. But generally, we just refer to it as just normal accounting profit, just refer to it as profits. So the general formula is accounting profits divided by capital employed. Please, are you still with me?
Yes, ma'am.
Thank you. So the general formula is accounting profit divided by capital employed. So now we are not trying to figure out each of these factors in the formula. First, the accounting profit. It says accounting profit is usually measured as an accounting profit after deduction of any depreciation charges on non-current assets. That is, this is the profit after depreciation. The accounting profit the profits we're using in our formula is the one that we derive after removing depreciation from it. So now moving on to the capital employed. Capital employed is basically the amount we spent on investment, the investment we used in that particular project. Remember, what we're trying to calculate is how well a particular division or investment is. When you're asked to calculate how well an investment is doing, if it's only for that investment, if it's not only for that investment, we're going to be using that employed by that investment alone. But if we are asked to calculate the how important for it, we're going to be including collection, then we're going to be using the capital employed for that particular department, along with the additional investments we just added. I'm not sure if you understand what I'm trying to say. If it is that way, we've been asked to calculate the amount of investments for investment.
Ma, the network is keeping again.
Hey, it's better now. It's better now. Can you hear me?
No, it's still skipping, ma.
I'm sorry about Is it better now?
Yes, ma.
Okay, thank you. So, where was I? Okay, I said if it is that we've been asked to calculate how well a particular investment or a potential investment is going to do, probably we've not invested in it yet, but we have plans to invest in it, and we've been asked to calculate the return on that particular investment. The information we'll be using will be the information relating to that investment alone. But if we've been asked to calculate the return on investment on a particular division or on a particular department, obviously we're going to be using the information they had before, along with the one they intend to invest in. It won't be only for that investment alone, because now we are checking how the whole division is doing. So we're going to be using all information available to us. Okay. So let me go back to my notes. So I said, how do we derive capital employed? I said capital employed is, like I said earlier, the investment, the amount we spent on that particular project, but it can derive in numerous ways. We have the first one, non-current assets plus working capital. That is, the thing is, capital employed ordinarily refers to net assets. Net assets. Net assets, the formula for net asset is total assets minus current liabilities. That's how we get our net assets. But it can be written in numerous ways. The way of writing net assets is this first one here, that we have non-current assets plus working capital. And how do we derive working capital? Working capital equals current assets minus current liabilities. So if you look at it clearly, you can see it's basically saying non-current assets plus current assets minus current liabilities, which is basically the same as total assets minus current liabilities. But just to break it down, non-current assets plus working capital, then working capital is our current asset minus current liabilities. Please, is that clear before I move on to the second form of capital employed we have? Hello, please, is that clear?
Yes, ma. Yes,
okay, thank you. So the reason why we have the various forms of capital employed is because we are not going to be given a definite format for our capital employed. It can come in various ways. So you are going to be the one to know what type of formula to use based on the information you have available to you. You are going to be the one to know the best type of formula to use to derive your capital employed. Of course, using the formula, the information that has been given to you in your question. So moving on to the second form, we have the non-current assets. That is non-current assets at initial cost or carrying value or carrying amount. That is, Ordinarily, our capital employed sometimes can just be the initial investment, or initial investment. If it is that probably the asset is going to be employed, it's going to last for a long period of time. It's going to be the initial investment minus that is cost minus depreciation, basically the same thing as our carrying value. So at the end of the day, it depends on the information you've been given. If the information spans for over a period of time, no, it is going to be um carrying value. But if it is that only for just a short period of time, it is going to be at initial cost. It's just going to be simply the amount you invested in it. So the next one we have is capital employed at the beginning of the financial year or end of the financial year, or average capital employed for the year. Like I said, it depends on the information you've been given. Sometimes you are just what's it called? Sometimes you have capital. You use if it, imagine if it is like you've been asked to calculate the return on investment for the old division. What you're going to be doing is capital employed at the beginning of the financial year plus capital employed at the end of the financial year divided by 2. That's not what gives us the average capital employed for the year. You're going to be using the capital employed at the beginning of the financial year plus capital employed at the end of the financial year divided by 2. So the reason why I said or end of the financial year is in the case where you've not been given capital employed at the beginning of the financial year, but you have just capital employed at the end of the financial year, you might end up using that one too. So it can come in various formats. It depends on the one that suits you best. So before we move on to residual income, let us solve a question on ROI. I'm going to send the question to the group now. Okay. Hope you guys are still reading. Our exam is already near. The exam is in May. Hope you are aware of that. The exam is very, very much near. So, well, please indicate if you've seen the question. Can you indicate if you've seen the
I've seen
question?
it, ma.
Okay.
Seen it, ma.
Okay, thank you very much. So let me change the screen to what to our visual Excel sheet. That's good. That's interesting. Okay. What's this question? Jeez. Wow, this is weird. Sorry, my mouse is not showing. Can't find my mouse. Trying to replicate something. Wow. This is something. So please, I think I have to shut down my system and start all over again. I can't find my mouse and I'm unable to go to share the screen I want to share. Okay. Please give me a minute to do that.
Okay, ma.
Okay. Kindly indicate if you can see the Excel sheet. Um, Hello, can you hear me, please?
Yes, ma.
Yes, I can, ma.
Okay, so can you see my screen? Can you see the Excel sheet?
Yes.
Yes, ma.
Okay, thank you. So let's start solving now. So let me go to the question. So the question says a division has net assets of 800,000 naira and makes an annual profit of 120,000 naira. But let me first read the requirement first. The requirement is what would the return on this investment? What would be the return on this investment? Return on investment should be measured on the basis of average net assets employed during the year. Should the investment center manager decide to undertake this investment or not? So a division has net assets of 800,000 naira and makes an annual profit of 120,000 naira. It should be assumed that if the investment described below is not undertaken, the division will continue to have a net asset of 800,000 naira and an annual profit of 120,000 naira for next 4 years. The division is considering an investment in a new item of equipment that would cost 80,000 naira. So that is the cost of the assets. The cost of what we intended to invest in is 80,000 naira. The estimated life of the equipment is 4 years with no residual value. The estimated additional profits before depreciation from the investment is as follows. Then we have given information, and further told that the assets will be depreciated on a straight line basis. Mind you, we take note in the requirements. We've been told that return on investment should be measured on the basis of the average net assets employed during the year. So these people have told us already how to calculate our capital employed. They told us already that we should calculate our capital, and I told you that capital employed is basically the same thing as net assets. So they told us that we should make it average net assets. And how do we calculate average net assets? I said capital, sorry, let me just write it down here. Average net assets. That's capital employed at the beginning of the year plus capital employed at the end of the year divided by 2. Divided by 2. Sorry, I want to check something. Since we are using the same sheet every single time, and we did ARR, you should be able to find it here. God bless. I got capital employed here. And there is another way of capital here. Average account rate of return. Average accounting profit divided by capital employed. Then we have capital employed equals initial outlay plus scrap value divided by 2. plus working capital. You see, there are different forms to get capital employed. This one is when we solve for ARR, and now we have the one when we are solving it under divisional performance. Everything is just to check how well a particular department or investment is doing. So let's get into solving. We have our ROI formula. Let's add our ROI formula. Our ROI is profit divided by capital employed, right? So that's let's try to get it now. We've been told that the division has net asset of 800,000 naira and makes an annual profit of 120,000 naira. That one is before the investment, right? It should be assumed that if the investment below is not undertaken, the division will continue to have the same thing. So that one is constant per se. Then it says the division is considering an investment in a new item of equipment that will cost 80,000 naira. Remember when I said what type of profit to use? I said it is profit after depreciation, right? That profit after we've deducted depreciation from it. So now that we've been told that the estimated additional profit before depreciation from the investment is as follows. Let me write it out. Or sorry, yeah. Then we have the profits. We have here 1, 2, 3, 4. Then we have the profits. We have 20,000 naira. We have 25,000 naira. We have 35,000 naira. We have 40,000 naira. 120,000 naira in total. So let's carry on now. Since what we're trying to get is our ROI, we have our formula profit, and we have our formula profit over capital employed. So we have to deal with it one by one. First, we want to get our profits, right? Then giving we getting out the information we've been given. And how do we get our profit? Our profit is profit after depreciation. So let's calculate our depreciation. What is the cost of our, and we're told again that the asset will be depreciated on a straight line basis. So this is the easiest way to calculate depreciation, right? So straight line basis of depreciation. What is the formula? The formula for straight line basis of depreciation, that's costs minus scrap value divided by number of useful life, right? So now that, what is the cost of our assets in this scenario? The cost of our assets will be given in the question. Please, what is the cost of our assets?
$80,000.
What do you say, please?
80,000 naira.
Thank you very much. We have 8,000 naira. We don't have scrap value. Okay, it was even stated in the question. It says the estimated useful life of the equipment is 4 years with no residual value. So we don't have scrap value. So we can, let me just there we. Then we can have number of useful life, that is 4, right? We've been told that it is 4 years. So let's solve this out, because 80,000 divided by 4. Yeah. So that means our depreciation amount, our depreciation charge is 20,000 naira. It's 20,000 naira per year. So let's calculate our profit after depreciation. This is depreciation. Since it's straight line basis basically telling us that we are going to be charging the same depreciation amount all through the useful life of the assets, unlike reducing balance or any other type of depreciation method. So since it is straight line, we have 20,000 naira. 20,000 naira. So Let's get our profits after depreciation.